Now, this is the answer. This could be one answer for business risk. Step 1, export sales undertaken for the first time. Step 2, adverse exchange rate volatility. Now you see what I've said? I said adverse exchange rate volatility. This could expose the company to exchange losses and cash flow problems. So you see, I've kept my answer very brief, very crisp, to the point. Step 2A, the implications. This may be a greater cause of concern in the absence of appropriate foreign currency risk management or risk hedging techniques. So it's a very brief, it's just, I think if you would write it, it's just 2 lines, 2.5 lines, and you will get full marks for this answer. This is a 2 out of 2. Right? Brief, crisp, to the point. Now, Rome. For Rome, step 1, export sales undertaken for the first time, just like you said, for businesses. Step 2, what is step 2? Calculate and conclude on the materiality of the issue. Not applicable, we don't have enough information, so we can't do that. Step 3, state the relevant financial reporting principles. Now, IAS 21 states sale transaction, because it's a P&L transaction, so sale transaction to be recorded at spot rate and monetary assets and monetary liabilities where there are fixed determinable currency units involved, like trade receivables. Trade receivables to be retranslated at year end. You have to retranslate your trade receivables at the year end, plus recognize exchange FX difference, exchange difference where? In profit and loss account. This is the basic principle that you need to keep in mind, because it's a sale transaction. There will also be a receivable. So initially, when you recognize your sale transaction in your books, you would use the spot rate. That is the rate prevailing at the date of the transaction, the date it meets the revenue recognition criteria. So what you would do, debit trade receivables, credit revenue. Now revenue is locked, but trade receivable, because it's a monetary asset, it has fixed determinable currency units like trade payables. So because it's a monetary asset, you would have to retranslate it at the year end. So whatever trade receivable you have at the year end, you would retranslate it using the, and at year end when you would retranslate it, you would use the year end closing rate or the rate prevailing at the year end. Plus you would have to recognize the difference, exchange difference, in profit and loss account. Step 4, illustrate the impact, link the risk in the scenario to step 3. The risk is, there is a risk that either correct translation, correct spot rates not used, or exchange differences on receivables not correctly calculated, recognized. This is the risk, this is the trouble. Now, if this risk materializes, what's going to happen? What is step 5? Step 5 is you have to illustrate the impact of the risk on the financial statements. So sales could be over or understated. Now, I'm not going to, in this particular scenario, because depending on what rate has been used, the sales could be under or overstated, and receivable and exchange losses or gains, depending on what rates are there, could be over or understated. So this example teaches you that where such complications of exchange gain losses are concerned, or where discount rates are involved, where rates are involved, and it becomes tricky. So you can simply say that sales could be over or understated, and receivable exchange gain losses could be, gains could be over or understated depending on what rate has been used. Is it difficult? Is it complicated?